welcome back to The Explainer. We've got a wildly fascinating scenario playing out in the financial world today. The Canadian market is basically putting on a masterclass right now, hitting these dizzying new heights. But beneath all that surface euphoria, well, there's a pretty massive undercurrent of economic hazards looming just on the horizon. It's a classic tug-of-war between record-breaking highs and some deeply serious threats. Today, we're breaking down exactly what's happening, why it's happening, and what it all means for the days ahead. Here's our roadmap for today's Explainer. First, the TSX hitting record highs. Second, the drivers behind the rally. Third, looming risks and headwinds. Fourth, corporate earnings spotlights. And finally, what to watch next.
All right, let's jump straight into Section 1. TSX hits record highs.
So take a look at this number, 36,759.29. That is where the S&P TSX Composite closed Thursday, marking an absolute all-time high. And this wasn't just some tiny, exhausted creep over the finish line. We're talking about a jump of nearly 100 points, capping off a remarkable 5-day winning streak. The momentum here is literally off the charts. And the best part? It's not just an isolated spike driven by one lucky sector. We're seeing this beautifully broad-based strength. Energy is up over 1%. Tech is surging nearly 2%, with heavyweights like Shopify and Constellation Software doing a lot of the heavy lifting. Then you've got financials showing really strong positive growth too, thanks to key analyst upgrades from major banks like BMO and Scotiabank. When you have energy, tech, and financials all firing on all cylinders at the exact same time, you get the historic rally we're experiencing right now. Which brings us to Section 2, drivers behind the rally. So what's actually fueling this? Well, 3 key engines are lining up perfectly. Step 1 is cooling U.S. inflation. The U.S. Producer Price Index just came in lower than expected, which instantly cooled off fears of further Federal Reserve rate hikes. That flashes a massive green light for global risk appetite. Step 2, Canadian economic resilience. We saw a surprisingly strong jobs report earlier this month, proving that the consumer and labor markets are actually holding their ground. And step 3 is sector rotation. We are watching money actively flow out of defensive plays and pour right into cyclical sectors like energy, materials, and financials. And as we know, those just happen to be Canada's absolute bread and butter. There's a quote from a portfolio manager that really hits the nail on the head regarding the mood right now. It is undeniable that Canada has significant potential and upside. Because of that aggressive rotation into cyclicals, the TSX currently has this distinct structural edge, and investors are completely leaning into that optimism. But that leads us to the multi-billion-dollar question, right? Can this momentum actually hold? Because as fun as it is to look at record highs and stellar jobs data, the reality is that this market is walking a very, very precarious tightrope. Let's get into Section 3, looming risks and headwinds. This is the first major threat, and it is a stark one. 50%. The United States is threatening to slap a staggering 50% tariff on a wide range of Canadian goods. And the deadline for this? It's just days away, on August 19th. High-level negotiations are going on in Ottawa and Washington right this second. But as of this moment, there is absolutely no deal in place. To put that into perspective, an estimated $28 billion worth of Canadian exports are directly on the chopping block if these talks fail. Right now, the market is pricing in a positive outcome. It's essentially assuming a deal gets done. But if we hit that 19th deadline without an agreement, it would be a staggering blow to the Canadian economy. We could see a very sharp, very sudden reversal for the TSX. And we're really dealing with 2 totally different flavors of risk here. On one hand, you've got risk 1, the acute binary threat about August 19th U.S. trade deadline. It's a yes or no event. But then you have risk 2, the chronic, complex pressure of geopolitics in the Strait of Hormuz. We're now entering the 6th month of a standoff between the U.S. and Iran, which is keeping global oil supply fears front and center and pushing benchmarks like WTI crude up near $86 a barrel. One analyst summed it up perfectly, noting, oil markets are tight and investors are coming to terms with that. Now, this is a fascinating double-edged sword. On one side, high oil prices are fantastic for Canadian energy stocks. It's literally part of the reason the TSX is hitting these highs. But on the flip side, if oil stays too expensive for too long, it threatens to reignite the exact same inflation we were just celebrating cooling down. That could really throw a wrench into central bank policies going forward. So why hasn't the market panicked yet? That brings us to Section 4, corporate earnings spotlights. It's because individual corporate performance has been absolutely stellar. acting like a massive shock absorber. Take Air Canada, for example. Shares surged 12.2% because they are forecasting a massive fall rebound in corporate travel. Then you've got Bird Construction jumping 11.4% on the back of a 49% surge in net profit and a record project backlog. And Shopify gained over 5% thanks to strong e-commerce data leading to raised price targets. These companies are delivering the actual fundamental results needed to justify their higher valuations, which is buffering the broader market from all that geopolitical anxiety we just talked about.
Moving on to Section 5, what to watch next?
In a market balancing on a tightrope, your best defense is knowing what's coming. Here is your immediate timeline. At 8:30 a.m. Eastern, we get U.S. retail sales. That's crucial for gauging American consumer spending, which directly hits our export-driven sectors. Then, at 10 a.m. Eastern, the University of Michigan Consumer Sentiment Survey drops, a massive, forward-looking indicator that's going to dictate the market mood heading into the weekend. And looming over all of it, August 19th, the critical U.S.-Canada trade deadline. You absolutely need to be watching every single headline coming out of those negotiations. Which leaves us with one final, pivotal question to chew on. Will the TSX survive the August 19th tariff deadline? We've got a market armed to the teeth with phenomenal corporate earnings, a resilient labor force, and optimal sector rotation. But we also have a potential $28 billion geopolitical shock ticking down like a clock. The fundamentals are undeniably strong, but are they strong enough to withstand that kind of a blow? Keep your eyes on the data, stay nimble out there, and thank you so much for tuning into this explainer. I'll catch you next time.